Well, a man who might be able to provide a little bit more perspective on that growth story is Sean Ashton. He's from Anchor Capital. He joins us now to take a look at the investment case for Alex Forbes. Thank you for joining us today, Sean. Reading through your note earlier on today, you anticipated that the share might list at 770. Today closed at 850. A bit expensive for the day?
I think certainly we still see value in the share. I think that was a note that we issued a couple of weeks ago. The anticipated listing price, what was priced in by the pref shares, which own a stake in the Alexander Forbes equity holdings business. At the time it was pricing 770, but ultimately the listing price is 750. I think we still see significant upside from these levels, and largely on the back of what we see as a potentially very, very strong dividend pay in the next couple of years.
Sean, it listed first in 1996, it delisted in 2007, today we're 2014, so it's got the 7-year itch, it got divorced, it got married, it got divorced, and it's remarried again, that 7-year itch thing. It's almost as though some cynics might say that this is the top of the market now, because it's obviously linked to the market, it's very much a JSE and other market indices linked product. But is that being too cynical, or is there something more to this than meets the eye?
I think there's certainly a lot of appetite for yielding assets. I think it's possibly indicative of where we are in the cycle of the market, in the sense that, and partially you're right, I think probably a third of the business is directly linked to asset levels from an equity market perspective, and that's really the investment solutions business. But when you look at the Alexander Forbes financial services business, that's really a fee-driven engine linked to number of members under administration in the case of pension fund consulting clients, and that's corporate clients. So that's not all asset market linked. I think there's an element of predictability to that business, and certainly not linked to equity markets directly. But I think moreover, this the appetite for the listing is indicative of a market which has got hunger for yield. And I think that one of the key attractions of Alexander Forbes is that their guidance has been 1.5 to 2 times dividend cover in future, given the fact that this business really converts its cash into earnings, or its earnings into cash. And we think that's conservative. We think that the dividend cover could be as low as 1.3 times. So when you look kind of 18 months out, you're staring a 6-7% dividend yield in the face. So I think that alone will drive a re-rating of the share.
Sean, I know we hear the whole time that there are going to be reforms in the pension fund industry, and I've had sight of a couple of documents from the Financial Services Board and from Treasury, and they're pushing towards the fact that I think there's a cost structure with inside pension funds where, as I said, there's small numbers, 1.5, 2%, where they think the charges are too high. And I mean, as I said, this is probably across the board, so not just singling out Alexander Forbes, but I did pick up that there was a push trying to move more into the retail environment. We know that the margins there are higher, they can accommodate that. But my fear is if there is a stronger pushback on cost to client and in the pension fund environment, surely that puts Alexander Forbes in a difficult position.
I think it's every business faces risks, and I think that's probably the key risk that you identify for them, which is why they're wanting to push into the retail space. I don't think it's going to be something which is going to manifest in a dramatic change in their results over time, but I would expect some pricing pressure on their core pension fund consulting business over time. Which is why that retail strategy is incredibly important. And I think what's incredibly valuable to them is the database that they have of clients on their books where it's high, in many cases, fairly high earning clients on the books of listed corporates, which they have all the information for. So they can target them as high net worth retail clients with a commensurately higher margin. But I think it's absolutely right, it is a risk.
Okay, going back to what Lindsay mentioned earlier, and somebody asked me this question today and I wasn't sure how to answer it, honestly. I'm hoping that you can. Now that the market's nice and frothy, close to the all-time highs, they list the stock. Are they not just feeding the geese? Are they not just getting rid of the stock now, listing it, getting the private equity guys out at a good price before the end as such?
I would argue otherwise. I think the valuation's more than acceptable. I mean, when you look at it's quite a confusing business to look at comparing the last couple of years with the results, because you've come out of a private equity environment where you've had a lot of debt in the balance sheet, which has actually resulted in the business itself making a bottom line loss. But when you look forward on a pro forma basis, you've capitalized all of the loans that they have that they previously had. You now have a business making R1 billion of EBIT with only R1 billion or 1.2 billion rand of debt. So it should be making, last year probably 750 million rands worth of pro forma earnings. This year we think it'll make 820 million rands, and you've listed it at a market cap of 11 billion. So on a per share basis, when you look forward to March next year, you're talking about 63 to 65 cents. A share price of 850 is a 13 PE. For a business that converts its earnings into cash and should pay you more than half of that back as a dividend, I think that's reasonable value. I think there's more upside.
Well, the one thing I could
Sean,
say,
let's go back to 2007. Why did it delist, first of all? And secondly, why did it relist in 2014? What's the difference between the company in 2007 to 2014? And this sort of leads on from Petri's very pertinent question.
Sure. So I think you probably have to ask the shareholders the question at the time there. I guess it was a judgment call made on the part of shareholders to take the company private at that point in time. But I think market conditions are very, very favourable for a relisting of a business of this nature right now.
Is there any difference between the company today in 2014 and what it was in 2007? There was a reason that they got off the market and a reason it's come back. Is there any difference? Has Alexander Forbes changed materially over the last 7 years?
I would argue that they've cleaned up their portfolio to the extent that some non-core assets have been sold off. You've seen the guard risk business was sold, which was obviously used to fund the buyback of a lot of the PIC notes, which was the very expensive debt underlying the private equity deal. So I think they've focused a bit more on their core portfolio. But to say that it's a dramatically different business to what it was 7 years ago is possibly a bit of a stretch.
Bruce, your perspective?
No, mine was just a comment saying a P of 13 in the market at the moment is a bargain. It's quite scary, but it is a bargain.
Maybe it is a bargain. But interesting, reading through the media, someone commented that PSG Consult is a way more dynamic and a diversified company versus Alex Forbes. Your perspective?
My perspective is that Alexander Forbes is a steady grower. I don't expect it to deliver 25 to 30% earnings growth. That's not what you're buying into here. What you're buying into is a fairly predictable earnings stream, which should give you 10 to 15% earnings growth and a prospectively very high dividend yield. So our thesis for thinking that there's a re-rating in play here is really to say that when you look 18 months out, a 6% dividend yield is not going to be a 6% dividend yield. It'll be trading at a 4 or 5% dividend yield. And when you look at the dividends that you're going to be receiving in 18 months' time, capping that at a 4.5 to 5% dividend yield is 11 to 12 Rand share price. And you're buying it at 8.50 Rand today.
So you're in favour of Alex Forbes versus
Sure.
PSG Consult, that's it. Well, thank you so much to Sean Ashton. He's from Anchor Capital, giving us his perspective of Alexander Forbes and their return to the Johannesburg Securities Exchange.